a great time as I need to get the market master for the day. Jyotivardhan Jaipuria, Head of Research at Bank of America Merrill Lynch, joins us. Good morning, Jyoti. Thank you very much for joining us.
Good morning.
Well, first up, how should one approach the markets itself for a trader? Is this cut, are the global markets looking like spoiling the fun for now?
Yeah, what we have to remember is markets have had a great run. Year to date, India is the best performing market, and we are up like well over 25% for the year. So to that extent, market probably needs a bit of breather just to pause a bit, and I think a bit of correction would be healthy. In fact, that's what we have been expecting, that markets probably pull off 5 to 7% in the next 2 months.
That would actually be nice to see, Jyoti. We haven't gotten a correction so far, so a lot of retail investors are still getting that left out feeling. But be that as it may, good morning to you first of all. I was going through your note where you mentioned that your index target for the year end is 27,000, but look where we are already, above the 27,000 level. Would you be scaling up your year end target now?
Yeah, it's like just 3 months left for the year, so essentially we are looking for that 5-7% pullback. So to that extent, we're not doing anything for the moment.
Okay. And what about for, say, the next 12 to 18 months? What would the prognosis be?
We are bullish longer term. So like we put out this report, I don't know if you got a chance to see it, that over the next 4 years, earnings will double and the markets will double. So, that gives a longer term picture of how we are looking at things.
Okay. No, in fact, that is the reason why we have invited you. That's very big analysis when you say that earnings will double. So what we are looking at is what 2,800 in terms of a Sensex earnings in 4 years or thereabouts, or even better. In that case, the index is really cheap. It is much less than even 10 times the index. But Jyoti, what can spoil the fun in the immediate? I mean, you're looking at very flat markets up to the end of the year. What can give way? Could it be inflation? Could it be, say, something like the coal scam? What are the red flags for this market?
Yeah, I think the biggest one is global, because ultimately India has done well this year, partly because of a lot of India factors which have worked out well. But we also have to remember that the emerging markets have done well globally, and that has been an additional factor helping us. So, we monitor emerging market flows. We have some tactical indicators there, and one of them is now flashing that probably we'll see a tactical correction in emerging markets itself. So, that's one thing which one has to be worried about. The other is India has been the darling this year, but there are a lot of other countries which are probably getting on the margin better, like a lot of people are getting a bit more comfortable in China. There are elections in Brazil where the hope is that this throw up something similar to what we had in our elections in May. So there could be other countries which could also demand money from emerging market fund investors. So to that extent, India may see a bit of pause coming through. The bigger picture, of course, is the US and the US Fed, and at some point the Fed probably moves and the market won't like it. So there is that thing which will be a fear nagging all the investors at some point. The timing for most people is sometime next year, not this year. But markets somewhere tend to, get a little worried much ahead of the event. So, that's one thing which could spoil the party also. So there are, I think, global is probably more important than India. Within India, of course, inflation print this week is going to be high. And to that extent, that's one worry which will continue to nag Indian investors. And probably, we've had reforms playing out. Reforms are playing out slowly. But investor expectations are got heightened with this rally. So to that extent, the pace of reforms would be steady and positive, but they may not be as fast as what the investors were initially expecting.
Okay. So let's talk about some sector or stock themes now, Jyoti. The biggest positive in the last week or so for us has been the way Brent crude has fallen below $100 a barrel. How do you play that theme? Do you do it via the oil and gas names, or do you do it through, some of these spaces like tire companies, consumer companies like paints, etc., that use crude as a raw material?
Yes, so, for us, it's been the oil and gas theme, which is the big theme to play, because there, there is anyway a positive momentum in terms of reform. So, subsidy, at least the diesel subsidies for all effective purposes gone, and we'll probably see, a move starting on LPG over the next few months. So to that extent, oil and gas is a theme which we are playing, and the falling crude price just helps accentuate that theme. So, that's one theme we are very positive on.
Okay. Well, let me come back to your doubling of earnings theme. What kind of earnings growth are you expecting in the current year itself? And when does the big bump up come? Is the big rebound FY16?
So, this year we are looking at something like 14-15%. The big rebound probably is going to be FY17 as a year per se.
Okay.
But probably the second half of FY16 will start showing that sort of rebound, which is 20% plus in terms of earnings growth.
Okay. Well, you spoke about the oil and gas as one of your preferred sectors. If you are expecting a doubling, then should not deep cyclicals like PSU banks be on your buy list?
Oh, PSU banks are on a buy list, so
Okay.
we like the banking space. We've always liked the private sector banks, but for the last 6 months, we've been actually pushing public sector as something which over the next 2 years is a great story, because as the economy picks up, we'll probably have NPL fears easing over there, and we'll get, a big re-rating coming through in the PSU banks.
So it's down the line, not just an SBI.
Yeah, I don't want to get into stock specifics, so there are some things we like, there are some things we don't like. But yeah, there are PSUs as a theme we like now.
Okay. How do you compare this phase that we are in between the phase that was from FY02 to FY08, where you did have, earnings triple, the Sensex went up about 5 times or so. Are we in such a phase, or given the valuation run up already, you can't really compare it?
See, typically what happens is when we are at a low point of the earnings cycle, logically the PE should be high. But most of the time, what we've seen through the last 25 years is we've had a situation where P's are low as well as the earnings cycle is at a low point. So we get a major move up in the market because the earnings pick up as well as we get the PE re-rating. This time, the earnings cycle is at a low, but we have P's which are quite high already. So to that extent, the market growth will more or less mirror earnings growth. I don't think there's going to be a major PE re-rating coming through. So I think, that's the difference between 2002, 2008 and now, where probably, that time markets did much, much better than what earnings growth did. This time probably markets will mirror earnings growth.
Okay, and that's an interesting point. We have a query that's posted on our Money Control message board, so I'm just going to toss that to you, Jyoti. K. Subramaniam has written to us from Sikandrabad. He wants to know if it's a good idea for retail investors to buy mid-cap pharma stocks like Wockhardt and Aurobindo Pharma. What are your thoughts on this?
Okay, so we can't talk on specific stocks, but generally pharma is a space which we've liked for many years, and we've now downgraded it to neutral. The whole reason is that pharma has done very well over the next 4-5 years. Some of the drivers which help growth are still going to continue, which is we're going to see a lot of generic drugs go off, and so that theme continues. But one additional factor which helped them was the rupee depreciation, which our view is that the rupee is not going to depreciate over the next 3-4 years. So to that extent, there are specific stocks in pharma which we like. But as a sector, I think, the returns will be much less than what we've seen over the last few years.
Okay. Well, since you won't talk stocks, let me try and get you as close as possible to giving our investors some advice. If I were to give you 100 rupees and asked you to invest in the Nifty, what would be the sectoral distribution be? And once again, if I were to give you 100 rupees and ask you to distribute between mid-caps and large caps, what would the split be?
Okay, so we have some sectors we are overweight on, so probably that's the easy way to answer. We are overweight just now auto, cement. So those are 2 biggest overweights. Third one is the banks. Fourth is oil and gas, and the fifth one is industrials. So in that order of preference, these are the 5 sectors which we are overweight on. So probably that's what we would overweight out of the 100 rupees.
So none of that 100 rupees would go to Wipro, Infosys, TCS at all? I mean, is IT out of the fashion?
No, so these are the overweight sectors really. Then after that, we have IT and pharma, which are neutral sectors for us. So just remember, IT is like a huge market weight. So we run like a benchmark portfolio.
Okay.
IT is the highest weight in the index for everybody.
Okay.
So to that extent, IT and pharma would be part of the portfolio, but it would be probably less than or more or less the index weight. And the rest of the sectors would be underweight in the sense that you'll probably have less than what the index weight is.
Okay. You don't have telecom that features anywhere in that list. You don't like names like Bharti?
Okay, so telecoms underweight for us, so is consumer staples underweight for us.
Okay, no, I was just wanting to finish my question. You were going to tell me about the split between mid-caps and large caps.
Okay, so I think mid-caps will do better than large caps over the next 4 years. So to that extent, mid-caps is something I would relatively be overweight on. But in mid-caps, there are two things. You have to remember the risk profile, because ultimately mid-caps are much riskier than what the large caps are. Secondly, they are less liquid than the large caps. So to that extent, depending on your risk profile, you probably would have, maybe 20% of your portfolio in mid-caps.
Okay. On an issue on which you have long taken interest, Jyoti, you are quite clearly the best expert on oil and gas space. Are you seeing globally a secular deceleration in crude prices? I mean, we have seen that double-digit 99 hold for the last 48 hours or 5 days. Is that going to be the shape of things to come? Three-figure prices for crude would be a thing of the past. Is that what the secular trend looks like?
Okay, I don't want to get into stuff. We have a global analyst who, his view is that crude is going to be softer over the next few years than it's been over the past 5-7 years. But his average crude price is slightly above $100, so it's, 3-digit. Even like 100, 105 would probably be good news for India, because, you have a stable crude price around those levels. It would be great news for India, because, just the current account deficit will look so much better. The whole subsidy pressure will ease off. So I think, we will probably have better times on crude in the next few years than we've had. The only thing I'll caution is typically crude has always done different from what the consensus view has been.
Okay. You did mention earlier in your list of overweights that you have industrials as well. What's the best way to play it? Do you think that one can still stick with the heavyweight names like L&T, or you should look outside the index to names like Crompton Greaves, Voltas, etc., which have already run up so much?
Yes, so like I said, industrials, in terms of my overweight, it's the last in the pecking order, because I think in terms of recovery, that is the last sector which will really start seeing the earnings growth. We prefer sticking at the moment to some of the larger cap companies, because they have a more diversified portfolio, they can do well. Amongst the smaller ones, I think some of the road developers are probably where the action is going to be from the government side, so that's something which we are looking at.
Jyoti, in spite of all the positives that one expects in the long run, when we speak to CEO after CEO, the attitude is, there is a lot of good talk, but there is really nothing on the ground that has changed. Practically everyone tells you that, including the very well-performing consumer goods stocks. I mean, take for instance a Whirlpool. The CEO was very clear that, we had an extended summer, late rains, and so we sold more. He's not even sure that first-time buyers have started entering the market. So when does the real pattern change? When do the first green shoots of growth come?
Yeah, so my view has been it's like a second half 2015 story. That's why when we discussed earnings also, I said the big earnings growth is going to come second half FY16. So it's, it will take at least 9 to 12 months before we start seeing things emerging that, okay, this economy is really turning around. It's not just sentiment which is changing. But, having said that, we probably have seen some improvement. Like if you see car sales for the last 3 months, that's been extremely strong, and it's been 3 months in a row. So to that extent, from the lows, I think we are starting to see that pick up. It's happening mostly in the consumer side and not in the industrial side. But that bit of pickup we've seen, I think it's going to be a slow process. It's not going to happen like suddenly we are back to 8% growth. But from these levels, I think things are going to look up rather than look down.
Okay. And would you play any of the, road developers or the power generators at this point in time? They are the most beleaguered, but this government is wanting to set that space right.
Yes, my view is that the road is easier to set, or road will be faster to set right than the power. So road is the first thing I'll play out of the two.
Okay. A lot of experts in the last couple of weeks have been talking about how the real estate sector could be the next big thing, as far as equity market gains are concerned. Do you like that space as well? And between large caps and mid cap real estate, what would the favorite be?
It's like quite a small sector in terms of the overall scheme of things. So what we've been playing over there has been some of these companies which are more into the office space, because you have the steady stream of rentals coming through. The new REIT regulation is going to help these sort of companies. So it's been like a mixed bag, but more on the office side than on the residential side.
All right, Jyoti, that's a large number of sectors you've spoken to us about, and your macro perspective that in 4 years the earnings of the Indian corporate sector is all set to double. On that note, thank you very much for joining us
Thanks a lot.
with your perspective today.